Another question from Rob. With the price to earnings in oil stocks still 5 to 10, can that be considered a bubble?
Yeah, when your earnings are going to go to zero in the long run. Yep.
Easy question, easy answer.
I know. This is a really good teaching point.
Yeah.
Man, not a teaching point. I don't mean to sound like a teacher. I'm not a teacher. A real good point that I'd like to make.
Mm-hmm.
I never look at, in terms of individual stock analysis, it is much more important for me to look at what is the price to sales multiple or price to earnings multiple. What is the multiple on your 2027, 2030 projected sales and earnings? I don't care what your forward multiple is on your 2022 earnings or 2022 sales. I don't care. That doesn't tell me where you're going to go. That tells me what's going to happen in the next 6 months. I'm investing for 3, 4, 5, 10 years. I want to know what you're benchmarked against 10 years down the road. And when you do that with oil and gas companies, I mean, these companies, they're going to have declining sales and earnings. So they're, for a lot of them, their 2025, 2027, 2030 sales and earnings multiples are higher than their 2022 ones because 2022 earnings and sales are artificially inflated by the sky high oil and natural gas prices you're seeing today. Everybody and their best friend, everybody and their mother is calling for oil prices to drop in 2023, 2024, and 2025. Therefore, oil companies, natural gas companies, their sales and earnings are going to drop in 2023, 2024, 2025. You cannot benchmark these companies on 2022 estimates that are artificially inflated by a near-term surge in fossil fuel prices. You have to benchmark them on the 2025, 2026, 2027 estimates that reflect much more normalized fossil fuel prices, long-run terminal fossil fuel prices. And when you do that, these are not value stocks. They're way overvalued. So 5 to 10 times forward earnings, I don't care. I don't care. They could be 1 times forward earnings. Give me the 2025 multiple. Give me the 2027 multiple. Give me the 2030 multiple. Then we'll talk. That's how I look at them. And that's why I get really excited about the hypergrowth stocks that we're talking about. Because when you do that same analysis, everyone's like, oh my God, it's trading at 8 times sales. That's ridiculously expensive. Well, guess what? It's also trading at 5 times 2030 earnings estimates. That's ridiculously cheap. All you have to do with hypergrowth stocks now is look out 3, 4, 5 years, and all of a sudden they're cheaper than everything else in the market. So everybody's discounting that growth to levels that should not be discounted. That's why I get super excited about that sector. When you look out long term, you look at those estimates, you look at the multiples on those estimates, hypergrowth stocks are dirt cheap. Actually, I would bet, and I don't know this to be true because I do not look at oil and gas companies all that much, but I would bet that if we just pick some random oil or natural gas company and we looked at its 2030 earnings estimates, that it would have a lower price to sales and price to earnings multiple on 2030 estimates than SoFi. That's what I would bet. I would make a strong bet on that. So anyways, that's my way of saying I look long-term, not short-term, especially when you're talking about a cyclical industry like oil and natural gas exploration. You can't look at the 2022 estimates. They're meaningless.
CS, I'm just, I love how.
You okay, Aaron?
I love it whenever we talk about oil. I love it because I love your take on it.
Okay, you want the oil take right now? We got some time. I know we're like an hour and 5 minutes. We got some time. Let's go. Let's hit it. At some point in the near future, oil is going to become a generational short. An absolutely generational short. You are getting rapid price appreciation ahead of long-term demand destruction, rapid, severe, and significant demand destruction. That creates a situation where oil is going to turn into a generational short at some point in the near future. Not right now. I think you got to get a blow your top off rally. I think you got to, I mean, that's how bull markets end, right? Bull markets end with this final hurrah, this big gusto push to the top. It's going to go to infinity. And that's when everything breaks. So I think you probably get a blow your top off rally to 140, 150. Maybe there's a temporary spike to 180. At any point there, when we start to get that blow your top off to the 140, 150, 160, 180 range, that's when you go short. You go short immediately then and there, because that is going to be a top, at which point oil is going to drop 70 or 80% over the subsequent 3, 4, 5 years. And my confidence in that is rooted in the numbers. When you look at the supply demand, oil prices are a function of supply and demand and nothing else. That's what it is, okay?
Yeah.
What determines the price of oil is supply and demand. Same thing as anything else in the market. And you look at daily supply, daily demand of oil. Over the past 50 years, we've sort of averaged this cadence of 2 to 4 millions of barrels per day of excess supply. So supply has outstripped demand by 2 to 4 millions of barrels per day. And that is led to price, and then it bounces, prices bounce between 20 to 100, 140 sometimes, and rare anomalies, 150, right? So we kind of get this bounciness there. When I run the numbers, the International Energy Agency said that the shift to electric vehicles alone is going to cause demand destruction of 5 million barrels per day on the demand side of the equation. That's the shift to EVs alone. Let's talk about the shift to hydrogen. Let's talk about the shift to solar. Let's talk about the shift to energy storage systems, wind, the real clean energy shift. That's easily another 5 million barrels per day of demand destruction. Let's call it 10 million barrels per day of total demand destruction by 2030. We're at 100 million barrels per day of demand right now. Take out 10, you're looking at 90. Let's go to the supply side of the equation. The markets are balanced right now, 100, 100. So supply is 100. You're going to get increased investment into building out the supply side of this market because of the elevation in prices. That's what happens in oil markets. Prices go up, supply goes up subsequently. But there's going to be some supply destruction as demand moderates, whatever. Let's say it's 5 million barrels per day of supply destruction. Then you're looking at a market that's got, by 2030, 90 on the demand side, 95 on the supply side. That is a surplus of 5. I told you before, we've never broken 4 on supply excess, 4 million barrels per day on supply excess for the past 50 years. We're going to be at 5, I think, by 2030. So that means my 2030 long-term terminal price target for oil should be below $40 a barrel, below anything it's ever been sustainably in the past. We're talking about a push towards 150 right now. What I'm saying is that you're going to get that blow your top off rally to 150, 160. It's going to turn into a generational short. We're going to drop to 40 by the end of the decade. People are going to make a lot of money on the short side of this trade. And I'm starting to hear murmurs of some hedge funds starting to go short the natural gas, the oil, the fossil fuel commodities. I don't think it's time yet. We got to get, like I said, that blow your top off rally, but pretty soon we're going to get it's going to make the big short of 2008 against the housing market. It's going to make that look like a small short. You're going to get a huge short opportunity against oil within the next 12 months, I think.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.